Today I'm talking about hedge funds. Don't know if you know what they are, but you've already seen one. You saw the snow fund we created last week. That's a hedge fund. It's a very weird, unusual hedge fund. Today we're going to see the more normal ones. But a hedge fund is what is a hedge fund? A hedge fund is an investment fund, and we know what that means, that has certain characteristics. It tries to exploit, it doesn't just invest in funds. I try to bring you back to the exercise we did last week. I forgot who my two traders were. I forgot who they were. You were one, right? And you were my hedge fund guy? No, you were my bank guy, right? Who was my mutual fund? Who was my hedge fund? I forgot. Sorry. I had two people. You were one. Yes, who was the other one? Not here, right? No. Okay, I forgot. So I had two. I remind you, one of them was what we called alpha. And the objective was to obtain returns, and you get paid if you meet a return, independent of the market. And the other one was paid as a function of the market. So the objective was to track the market and then beat it. So today, what I'm talking about, 100% of my time today is going to be devoted to the alpha person, the alpha trader, the one whose job is to meet a certain percentage return, period, independent of what the markets do. And that is what hedge funds are. Last week we saw the significance of that within the whole realm of investments. Today, we are seeing that we're just focusing on that. We're just focusing on how these investments are made. The objective is to get a return which is independent of market movements. Markets could go up, could go down. Your objective is to make money no matter what. That doesn't mean that in the end you end up picking up market behavior. Some hedge funds, they go up when the market goes up, and they go down when the market goes down. But that is not really their ultimate intent, as we will see. We will see today all of that. And to do that, they can do very weird things. They can do products which can be even very innovative. They can trade over-the-counter securities. Mutual funds cannot do that. Mutual funds are very restricted by the regulation to trade very simple instruments. Many of them can only buy stocks. That's all they can do. Okay? So we're not talking about those today. We're talking about situations where they can do many things, and it comes with restrictions. And again, I refer you back to our snow fund that we did last week, which is a very good example of how hedge funds work. In fact, I want to say that was a hedge fund, very cool one. They are very often very innovative, as we will see today. They do very, very interesting things. And what I have here for you is a scattergram. The only reason I have this to show you the variety of returns and risk profiles we can get from hedge funds. So in this scattergram, what I have on the x-axis is the risk that they take from the standard deviations only. We're only interested in that today. So you can see some of them are very much to the right, some are very much towards the center. Some of them have very high risk profiles, some have very low risk profiles. And some of them have very aggressive returns and others don't. Okay? And perhaps the one aspect or one visual information you get from that is that they're all different. It's very hard to box them into groups. So when you talk about hedge funds, you're talking about a group of investments that have very, very different risk return profiles. And today we're going to see a number of them. I don't know how many. I'm going to start with the most simple ones, and then depend on how many stories I tell you, I will be able to describe many strategies or a few strategies. I tend to have a lot of stories to tell you today because of one thing: hedge funds are all around you. You don't see them, but they see you. They're everywhere. They're not very big. Today, the total assets under management of the hedge fund industry is probably only $4 or $5 trillion. Which is big. It's, the GDP of Germany. But still, comparable to the whole investment sector, is not huge. It's not huge. But they're everywhere. Why? Because they take care of the alpha production, as we saw last week. Okay? So look at this from the perspective of what we saw last week. Now, there's a lot of different strategies. We're going to see a few of these today. I'm going to start with stocks, which are the most common ones. But then I'll spend a lot of time today on convertible arbitrage, because you will see you are very close to being very good at that, and that will give me the opportunity to tell you a lot about how financial markets work. That will show you how, that will prove my statement to you that hedge funds are really everywhere. Okay, so I start with equities. And I start with equities long. I want to talk about long only. And there's essentially 4 strategies that I want to mention here for you. The first one is what's called fundamental. Fundamental equity, I have here a picture of Warren Buffett. He is the paradigmatic long equity investor. And a lot of these are based on what we call the value investing. So I have to remind you of a picture we already saw here. 100 years ago, something important happened, which is accounting was regulated. Companies who trade in the stock market have to provide accounting statements which are correct. Companies that do not trade in the stock market, they have to give information to their shareholders. So there may be some legal aspect that also forces them to do accounting. But for sure, if you're in the public market, you have to report your accounting statements correctly. And that has been going on for about 100 years. So for 100 years, investors have focused on analyzing those financial statements to make investment decisions. And Warren Buffett is considered to be one of the best. And I'm sure you know Warren Buffett. You heard of that name. Okay, so he's there. And this, I'm going to describe that style in some detail. Another style that grew around the year 2000 is what's called now growth investing. And these are the following. Around the year 2000, investors were making fun of technology companies. Why? Because they defied accounting analysis. Facebook went public on an IPO of about $1 billion with 0 revenue. Fundamental investors would say, that's crazy. Why would you invest in a company with no revenue? We know why. Because their revenue was forthcoming. And so was Google, and so were many of these companies. So this was an investment style which is forward-looking, that defied the investment style around the year 2000. So growth investing has been around for about 25 years. And it is, for example, what prompts investors to invest in companies like Microsoft, which I will describe in some detail today. Microsoft 2003, not today. Microsoft 2003, when there was this story building up whether technology companies would go anywhere. Yes, believe me, in the year 1999, most investors thought investing in Google was stupid. Stupid, okay? They didn't even like the name. And there's something in the middle, which is called a GARP investing. GARP is growth at a reasonable price. This is a blended style that developed once growth took over. There was a lot of investors moving into the growth area, but now they say, well, growth, yes, but I also like the fundamentals. So they found some common spaces. Growth. It's called GARP. The other one is momentum. And with momentum, I have to say a few things. Momentum is investing in a stock on the long side, a stock that is just going up in price, and you just try to capture that directionality in the. I guess you know what I'm talking about, right? And momentum is the stock is going up. I have an example here, which is the traditional example of a momentum trade, even recognized by the CEO of the company. This is Netflix. Netflix was one such company. It was that tailwind was coming from two areas. One was the demise of Blockbuster, that was his competitor, and the fact that streaming became commonplace around that time. So there were subject. So then investors very quickly started to make projections as to where they was going to go, and then there was a lot of social hype built around the stock, and even the CEO call that a momentum trade. But I have another example that I also call a momentum trader. That's a GameStop. I guess you're familiar with a GameStop. I think we talked about that. We'll talk about that again. For me, that is a very good example of a momentum trade. And today, momentum trades are fundamental. Momentum trades are everywhere. They're very ubiquitous. Why? Because we live in an ultra-connected world where social groups can have tremendous power to move markets independent of any analysis. Social trends can defy analysis. Some stocks just go up because they go up. Everybody likes them, they go up. And there's investors trying to capture that. So the concept of momentum investing has been around for a long time, is now taking a whole meaning on its own. And the other one that is also taking a whole meaning of its own is technical trading. Technical trading is a type of trading which is very, very old and it's really not interesting. You may have heard of these guys that look at a chart and they have these magic numbers. If the stock has dropped 10% from the previous high, they say, oh, it's going into bear territory. Have you heard of this? Okay, great. Think of that as a homemade, very simple neural network. You just have these numbers that came out of tradition. And of course, if enough people believe in them, then it could become a self-fulfilling prophecy. So there's some mix between momentum and technical analysis. But today, technical analysis is being redefined. And I would argue that a lot of the algorithmic trading that is being done using neural networks is a type of technical trading where the technical parameters are not done by humans but done by computers. So this gives us a way of analyzing the methods that exist out there to take long positions on stocks. Almost every decision you make is one of these. Whether you make your investment decisions talking to your friend, that will be momentum. Whether your investment decisions by analyzing the company and how much you like the financials, that's fundamental. Whether it's you thinking different from everybody else, this company is going to be fantastic, just no one knows about that would be growth, right? Or you say, you know what, I don't know anything. I just put the numbers into my computer and see what my neural network tells me to do, and that will be technical. Almost every way of investing is going to be subject to one of these. I'll describe very simply the fundamental equity trading. What they do, fundamental equity traders, they would look at companies' financials. I have some example here. This is a very old screenshot that I took from Google Finance many years ago. And then the company has certain parameters in that. I have some of them here. You can look at price to book ratios. You say, well, the price to book is very low, so that's a buy signal. We got free cash flow is very large. That's a buy signal, right? EBITDA, that's earnings before income tax and appreciation. That is that if that is very large, it's a buy signal, and you use this to compare between companies. Okay, so these are some of the metrics that fundamental investors take. Now, there's a bit of an art here, and you have to be very good at corporate finance when you do this, because you cannot follow the same metrics for, say, a technology company or a bank. The metrics are very different. Right? That's where, for example, what I have here is have a comparison on the numbers for say, technology companies. You can compare Verizon with Apple and Microsoft, and looking at the different numbers is how you build your investment decision. Again, most investors in technology will be growth investors, not fundamental investors, but I use that as a way just to show you how that is. Okay, and some of you may invest this way. If you do investing, some of you may invest looking at that. All right. The other one is growth, and growth is focused on different sets of variables. For example, some of the sets of variables that growth is focused on is historical growth strength. You look at how I want to go through this a little bit quickly, okay? Because I want to go to the example, Microsoft example very quickly. You're going to look at your projected earnings growth. You're going to make projections. You're going to see how this company is going to evolve in the future. You're going to look at how the revenues are going to go up, how the costs are going to go down. This is what you look for. And it's all, as you can see, it's all forward looking. In the case of Microsoft, I have here what their historical growth was, and is very above their peers. Then you can look at the projected earnings. Then I have here I can't see my computer, the cost and revenue control, again, well above of their peers. And finally, what you have is the return on equity. So all of these are typical parameters that growth investors will be looking for. And you use this information to make your investment decisions in the future. Yes?
What's the overlap between like the metrics used for fundamental equity investing and growth?
Okay, all of these are forward-looking. For example, when you look at, let me look at, for example, EPS growth. Okay, the thesis here is that if you are at 5%, for a large company, if you are at 5% over the last few years, then you're above the average. So you're going to be going up in the future. When you look at the cost and revenue control, is that if your costs are down, that is going to give you projections for revenue in the future which are above average. And there is some thresholds which are considered to be relevant for this projection. They're all forward-looking. For example, price to book is not considered here. Price to book is the typical example of what a fundamental investor would look at. Why? Because the book value is what you buy and the price is what you pay. So if that ratio is good, you buy it. But for these companies, price to book may be terrible, like in the case of Facebook. It was infinity. Price to book was infinity because book value was 0. But if you make your earnings growth projections, then it would be very good. Okay. Now let me talk about shorting stocks before I leave the world of equities. Shorting stocks is, we've already shorted stocks here. We shorted stocks academically in the first half of this course. Now today we're going to short stocks in real life, and things are slightly different when you short stocks in real life. So how does shorting stocks work? Okay, when you short stocks, there's a whole process involved in shorting stocks. Up until now, shorting stock meant you buy a negative amount of stocks. When you buy a positive amount, what happens? You pay money. When you buy a negative amount, you receive money. When you buy a positive amount, if the stock goes up, you make money. If you buy a negative amount, if the stock goes up, you lose money. So that's true, but how does that work in practice? You cannot just call your bank and say, I want to buy a negative amount of stock. You can't do that. You can only buy a positive amount of stocks according to the law. So what you have to do is you call your broker. This is important, you will see why. You call your broker and say, I want a short stock. What that means for the broker is that you're going to borrow someone else's stock. So the broker is going to look for an existing stock in their inventory of stocks, and it's going to lend it to you. Once you have it, you're going to sell it, you collect the cash from the sale, and then there's an entry that says that you owe a stock. That's how it works. All of this happens perhaps quickly, but all of that process is created when you short the stock. That means that the broker has to locate a stock available for loan. If you want to short stock and there are no stocks available for loan, you cannot short it. They need to find someone who's willing to lend it to you. That's called the locate process. And this is the reason why if you're going to buy stocks, you can buy stocks with just about any broker. But if you're going to short stocks, you can't do that. You typically go to the big brokers who have a lot of inventory. If you go to a small broker, they may have a little bit of inventory, and guess what? When you borrow stock, you have to pay a rental fee on the stock. And the rental fee could be very large for a small broker, and it could be very small for a big broker because they make money on the volume. And the locate process could be faster and very automatic in a big broker because they do this all the time, and it could be very slow in a small broker. So the shorting process is very dependent on your choice of broker. Buying stocks, not so much, but shorting stocks, yes. Fundamental difference. Okay? But there's more. There's another thing which is called the uptick rule. And this is something that was introduced in 1934. I remind you that 1934 is when the the Investors Act was launched in the United States. And what that did is the following. Once you borrow the stock, you cannot sell it immediately. You have to wait for the price of the stock to go up one tick at least, and only then you can sell it. You know what a tick is? A stock have prices, right? As a trade happens, then it's a tick. It's called a tick because every sale of a stock generates a number. And if you look at it trade by trade information, you need to have witnessed a price uptick before you can sell it. Okay, so that was done to prevent a situation where the stock keeps going down, and then people just continue to short. Of course, when you sell, the price continues to go down, and that was done to prevent stock manipulation. Because without that, if I have enough money, I pick a small stock and I just drive it to the ground. Understand? I just short sell until and then of course I make a fortune, right? That was abolished in the United States in the year 2008. But it still is in place, for example, in Japan. Why? Because North American markets are very large, other markets are very small. And therefore, this is a protection measure against stock manipulation. Okay, we don't have it anymore in the United States, but in other jurisdictions we do have that. And another thing which we have, and this is very, very significant, which is if the stock you borrowed and you sold and you collected the cash, if that stock, the original owner of it wants it back, you have to return it. In other words, when you buy a stock, you decide if you're going to sell it. But if you short the stock, someone else is going to decide if you have to return it. Normally, the institution or the owner of the stock, could be a company, the owner of the stock, if they want to sell it, the broker, they sell that and then they will swap your stock borrow for a different one. But what if everybody wants to sell? Then they can't do that. Then they call you and say you have to return that stock. Understand? When that happens, this is called a short squeeze, and I'm going to show you today one of the famous ones that happen. This can be brutal when that happens to you. Okay? It can happen when you're long, but it can happen when you're short. You had a question?
Is there no way to short it with like a fixed lockup so that you don't have this sort of exposure to the lender where they can't recall it? Is there not a way to?
I've never seen that.
Okay.
Never seen that. That could be an over-the-counter transaction. You could have an over-the-counter transaction that is on a lock. But usually when you short, the owner has the right to recall anytime.
For the locate process in private equity, for example, who's handling that? Would that be like
Oh, okay. Yeah. No. So private equity will be very different. Because see, I am not sure how that would work in private equity, and let me tell you why. Okay. A lot of the rules that exist for stock ownership for public stocks do not apply to private stocks. Typically, when you have a privately owned company, there's a shareholders agreement which has typically restrictions on who can buy and sell and how. For example, in a privately owned company, the shareholders agreement, which varies by company. Companies could have the weirdest shareholders agreement. If the shareholders agree, go ahead. But usually, there's a clause that says that if someone wants to sell, the existing shareholders have priority. You can only sell it to them. Okay? Sorry, they have the right of first refusal, meaning if someone is willing to offer you $1 million for your stock and none of the existing shareholders is willing to give you that, then you can sell it to them. But they have the first right of refusal. If they say, no, I'll take it, that's a good deal, I'll buy it from you. There's also these other clauses, which are like the tag along, which is if you want to sell, I have to sell with you. I don't have a choice, unless I want to give you a better price and buy yours. It's a protected mechanism, which is different from publicly traded stocks. That's why the process of doing an IPO is so complicated, because you're changing the capital structure of the firm entirely. And the shareholder agreement, you have to shred them and create some new ones which are compatible with publicly traded stocks. When you have publicly traded stocks, you have the same rights to buy the stock as whoever gives the best price. In private stocks, you don't. So when it comes to, and also typically you need a board resolution to allow the sale of that, whereas in a publicly traded stock, you don't need any board resolution. People just buy and sell. That's why to do a short sale on a private company is so different. And frankly, if it's also weird, you know, to short a company which is publicly traded. A lot of the short transactions are private, like you are behind the broker, so no one will know who your identity. But in a private stock, you have to publicize. People will know who is the one who is short the stock, and that creates a whole game theoretic situation of its own. I've never seen that. I'm not saying that it doesn't exist, but I've never seen that.
Yeah, it does create an interesting self-fulfilling prophecy.
It does, yes.
You're on the cap table, you call the whole board goes, what do you mean you want to sell this thing? Fine, we'll do it for a big spread.
Yeah.
Everyone suddenly thinks
Yes, that's right. Yes. So anyway, I've never seen that, but look, there's lots of weird things going on out there that I've never seen. So, okay. So again, to summarize, this is essentially how the process works when you're short selling stocks. So everything that I said is here. Okay, everything. There's no new information here. Let me go to the case, which is the one that I like to use to explain short selling and how dangerous it is. Short selling has a lot of risks of its own. And I want to tell you what happened to Volkswagen. I'm going to tell you lots of stories today, because that's how you understand trades. Are you aware of the history of Volkswagen? You know Volkswagen, the car company, yes? Okay. Maybe you've driven one. You know the story of Volkswagen. Okay, so the story started with Ferdinand Porsche. And they say Porsche, they don't say Porsche, it's German name. Ferdinand Porsche was an industrialist, a German industrialist, who was doing agricultural equipment, like we had in Canada, Massey and Ferguson and these guys, they were doing tractors. And then when doing automobiles became the thing, he started the automobile division. When Hitler took over in the Third Reich, he forced the sale of the automobile division of Porsche to the state and changed the name. Volkswagen in German means the car of the people. Volk is like folklore, folk, same word, and Wagen is the same as wagon. Okay, that's Volkswagen, that's the name. And I'm told, I wasn't there, but I'm told that Ferdinand Porsche was very upset by that and actually made his family on his deathbed swear that they were not going to rest until they get Volkswagen back into the family. Okay, that was, and the family went for decades waiting for the time to get Volkswagen back. 2008 was the year of the big crisis. I probably told you, we studied the Goodrich swap of 1982. 2008 was worse than 1982. And I told you how bad car sales were in 2008. I think I told you that the implied lifespan of a car before you get a new one was like 30 years. Okay, you were going to hold on to your car for 30 years. It was unreal. It was very, very bad. Because of that, car manufacturers were the favorite shorts of hedge funds in 2008. every car manufacturer was short on hedge funds books. There's a very interesting short, which we didn't participate, but it was there. There was the, back then in 2008, Volvo, the car company, Volvo, was owned by Renault, the French company, 100%. Turns out that you could, the price of Volvo was more than the price of Renault. In other words, that means that you could buy Renault, the whole company, then you sell Volvo, and that will make you money. That was an arbitrage opportunity in 2008. And the reason was what? Is investors somehow trusted a Swedish company more than a French company, despite the fact that the French company owned 100% of the Swedish company. Now Volvo is a Chinese company, it's held by Geely, and so the story has changed. But these were some of the, how can I say, dislocations, price dislocations that we observed in 2008. Be it as it, and you probably know, General Motors went bankrupt, Chrysler went bankrupt, Ford was this close to being bankrupt. It was just a mess for car manufacturers. So car companies were everybody's favorite short. And Volkswagen was also in everybody's short book. It was also in our short book. Okay, I had a portfolio back then in my company, Sigma. This was the occasion that Porsche used to try to get back the Volkswagen company. Let me show you what happened, and this is very interesting, very, very interesting. Let me show you the shareholder structure of Volkswagen back then. Okay, this is interesting, you will see, okay? Porsche owned 42% of the company. The state owned about 20% of the company. Then we had 13% of the stock was on loan for shorts. Okay, 13% is the short positions on that, which means that the float available for trade was around 25%. In other words, 25% of the stocks were free, floating. They were unencumbered stocks. Okay? Now, on Sunday, October 26th, there was an announcement by the chief investment officer of Porsche, and it was not about cars, it was about stocks. He announced that Porsche had been building up a position through options, cash-settled options, to acquire 31.5% of Volkswagen, the company, which would bring Porsche into the 75% range ownership of the company. You see that? They had been building up that. And now I can say, for years I couldn't say that, but it was finally published, that this trade was brokered by Maple Bank. Maple Bank was a Canadian bank, owned in part by the Ontario Teachers' Pension Plan. I can say this because it was published, so it's now public information. And I'll tell you what happened to Maple Bank. The whole story is very... Someone should make a movie about this, by the way. Okay? If any one of you likes to make movies, I'll help you. I have all the information. It's just fantastic. Just wait, okay? So what happened when that announcement... It was made on a Sunday. I remember we were short Volkswagen, and I received a call about 5 p.m. on Sunday. I received a call from one of my managers telling me that this announcement had been made. Why? Can you see something going on here?
Sounds greater than 100%.
It's more than 100%. So what happens then? Everybody knows what's going on. Everybody knows what's going to happen on Monday when the market opens. Right? Let's say, let me try to get you to understand this. Who wants to be long Volkswagen here? You like to be long Volkswagen. Okay, so Sohyung and Eric, you're long. Who wants to be short? Henry, right?
Yeah.
Okay. I still don't know your names, and there's only 1 week left. Okay. Remember, it's 10%, right? So Henry here is, you're short, right?
Yeah.
Great. All right, so what do you do? Sunday.
Sunday.
Yeah. You're there, you're short. What do you do?
Could you give me a quick recap of the situation?
Yeah. I need some more people to be short, okay? I have to explain this. You just discovered that 31% of the stocks of Volkswagen are actually committed to Porsche, right? So someone is going to be buying stocks. Someone's going to, you don't know who, but someone's going to be buying. They already have stocks. Someone's going to be buying stocks, right? At least the broker, Maple Bank. And if they're going to be buying stocks, they're going to be buying more stocks than they're available to be bought. So eventually they're going to run out. You're going to get a call from the bank. Let me be the bank, the broker. I'm going to call you and say, Henry, you have to return the stock. So what do you want to do? Do you want to wait? If you wait, I'll probably call you to return the stock when the price has already gone way up, right? More stocks will be bought than there are, so the price is going to go up. So you try to cover your short as soon as possible because the price is going to go up. There's no question about that, right? Okay, so who else wants to be short? Oh, you like pain. Good, okay. Okay, so what do? Same thing, right? You guys, you're short. You have to get rid of your, you have to get rid of your short. You have to cover your shorts. And it's Sunday. So what do? You call who's long. So you're long. You call Eric. Say, Eric, we went to APM 466. Your buddies. Why don't you sell me some stocks now?
I do not want to sell them.
Well, you see, it doesn't work. So you know, but you're a bit desperate because you know you're gonna be hit. You know that you're gonna be hit. You. Okay, so what happens come Monday?
I will set a very high price to me.
You will set a very high price. Okay, you're gonna put a very, very high price. What do you guys do? Now he's selling, but very high price. What do?
If I think it's going to go even higher.
Well, that's it. You have to now, one of the three of you is going to have to make a choice, right? And you know, you've been talking on Sunday to each other, said, oh, I'm short. Oh, you're short also? Damn, what's going to happen now, right? So he gives an ask. Who's going to cover his ask with a bid? Well, whoever is first, right? So you guys know, say, well, no, you know what? No, I think that's too high. I think it's going to go down. Maybe Henry thinks that. But your name?
Victor.
Victor, right? So Victor said, no, you know what? I don't like this. I'm going to just get you buy, and the price goes up, right? Understand? Okay, I'm giving you a summarized version. So then, Henry, what do? You say, well, damn, Victor beat me, damn, I talked to him on Sunday. I told him my position, and now he beat me to it, right? He said, well, maybe it's going to go down. You're hopeful, right? But then Sokyung said, wow, it's going up. The first stock in my portfolio that's going up this year. Then what do you decide to do? Allow me to tell you what to do. You're going to sell. It just went up. Said, oh my God, I'll sell it for a little bit higher, right? Then, well, there's another sell offer even higher than that because she wants to get out of the stock. She finally can make some money in 2008, right? Your name? Max. So Max and Henry, you're the two left, and she's giving a what? A sell order.
It's like
What do you-
one than before.
Yeah, of course, even higher. I have the numbers here. I have the numbers here. Okay. 286%. That was the final trade. Okay, 3 times the price, even higher. What do you do? So now the two of you, you're say, well, look, I lost. You're crying, but at least you're out, right? What about you guys?
Try to cut losses as soon as possible.
Well, okay. So Max is still thinking. So he's first. So he gets. Now you're next, right? Now you're the only one. Another one who we still have some shareholders left. Anybody else wants to sell? Please, Olivia, sell. Much, much higher. I said, sorry, I have no more inventory left. You have to, and now you have to pay that like the top price. Right? Right? Yeah. So that was a bloodbath for those who were short. Of course, the happy owners were like, I made some money on some stock in 2008. Do you understand the dynamics here? So this is real. It's called a short squeeze. You probably know the short squeeze in GameStop. Which is, sorry? Okay. Gamma squeeze. You also read Wall Street Bets, right? Okay, so let me come to the gamma squeeze in a minute, okay? Let me make sure this understood. All this understood, you understand Volkswagen, right? How did the story end? This is where the movie starts. Anybody knows who owns Volkswagen today? Anybody who owns Porsche today? Volkswagen owns Porsche today. So this created a war, a commercial war, and Volkswagen ended up buying Porsche. And by the way, the broker for that transaction, Maple Bank, was raided by the German tax authorities and went bankrupt. Part of the same war? I don't know. That's the movie that someone should make. Okay? So that's a short squeeze. What's a gamma squeeze? You said the term. You know what it is? We explained that here actually in class, right? So it's a rhetorical question. So that's right. So it's an option-driven short squeeze situation. Why? Because gamma, what did gamma tell us? Gamma is the derivative of the delta. Delta is the volume, the trade volume. Because delta, I remind you, according to the Black-Scholes theory, is the position you need to have on the underlying to cover your hedges. So delta is the position that Maple Bank had as the broker to give the options to Porsche, right? So if the value of the underlying, the hedge is the delta, the gamma is the volume. So if the volume is created, not by these guys buying and selling, but if the volume is created because, in this case, Maple Bank has to buy, that creates, so these guys are not buying, I'm the one buying, because I have to, that's part of my hedge. And we saw here that the volume of an option issuer is the gamma. When the purchasing act is from that, and I throw these guys into a loan recall, that's called a gamma squeeze. It's a short squeeze, which is created by option trading, not by owners of the stock, not by shareholders. Okay? The effect is the same. The motivation is what's different, right? Maybe here, Maple Bank was the one also buying because they had to buy because they had the options, right? I don't know enough about this case to know when were these options due. Okay, so, and of course, another thing for the gamma, again, these are things that are already explained here. Remind you, the gamma has a singularity when you're close to maturity and close to the strike price. Why? Because the option price has a singularity point at the strike price, where the second derivative is infinity. The first derivative is a half, but the second derivative is infinity. That's where the volume goes to infinity, when you're close to the expiration date and close to the strike price. Okay? Very simple, intuitive differential equations. Yes?
Porsche used these numbers. Did they pick this number so that the price went up?
I don't know. What I do know is that Porsche made $1 billion in this transaction, or €1 billion, €1 billion something. They made more money on this transaction than selling cars. that year. I also know that they were indicted for manipulation, and I lost track. I mean, I did see Maple Bank being shut down, but then I lost track, and their net result was that Volkswagen bought Porsche. Yes.
What was illegal that Maple Bank did?
What was the what?
What was illegal about?
Okay, no. So the allegations from the German tax authorities is that they broke the law in the tax withholding for short dividend income. That was the allegations. By the way, I don't think this is ever going to court. For all we know, the allegations were wrong. There were, the German tax authorities come and they accuse you of something. Maybe 10 years later, oh, sorry, we were wrong, you're right. But you're bankrupt by that time. Because when the German tax authorities, they accuse you of something, your lines of credit dry up. And for a bank, that means death, right? Good luck suing the German tax authorities. And I say this in video, okay? So
was it settled, or was it just lawfare and then tied up?
we'll have to wait for the movie. And we will need some sort of a conspiracy theory hypothesis that that the CEO of Volkswagen called someone, and then someone called someone, and someone knew someone in the government, and then finally something happened. I don't know. What I know at the end is that Volkswagen bought Porsche, Maple Bank ceased to exist, and so on and so forth. And this is in a paper. If anybody's interested, I'll give you the paper. So I'm not giving you any information which is protected. I've known a few things for a while, but now it's been published, I can talk about it. This is the first time I can mention this. I saw the paper a few months ago. Interesting, huh? But short squeezes happen without big headlines. GameStop was an example. Gamma squeeze, same thing. Okay? All right. So there are risks in shorting stocks. I'm not going to tell you that these things happen all the time. But other things that happen all the time is that making or obtaining profits on short transactions is something that you can do, and some people do it. I knew a hedge fund in New York consists of three people. They're all lawyers, and all they do, they go to work. All they do is they look at filings of the Securities and Exchange Commission, which are public. The SEC says, this company, bad boy. Why? Oh, short, right? That's all they do. And by the way, you can have now an LLM doing that for you very quickly, right? Prompt, stay alert to SEC filings. Okay. See something negative? Short the stock. Okay. Go have a sandwich. And then the LLM will do the trades for you. You understand what I'm saying? Now, the problem is that this is a stock which is open to lots of risks. This company is, the SEC is after that because they did something bad. The stock drops. So, oh, great, I made some money for a few minutes. Then Microsoft comes and says, you know what, I'll buy the company. Quickly. I can take care of the allegations. And then the company goes up by a factor of 4. You lose 400%. There's unlimited liabilities when you are shorting stocks. And some of the very violent price movements up are from takeover operations. A takeover is the nightmare of anybody shorting stocks. Sometimes you need to buy the stock and you don't want the shareholders to, we'll see examples, you don't want the shareholders to pose any problems, so you just give an offer which is above market prices, and then you can demand a very quick execution and the board will do it very quickly for you. Okay. Or a situation you short a company, say very, very typical, a drug company, it's under difficulties, and then suddenly the FDA approves their cure for cancer. price goes up by 4 times. You're out, big time, right? So these are some of the risks, but to avoid short selling squeezes, there's a ratio that short sellers always look at, which is called the short interest ratio. It's the ratio between the short interest, how much money is out there, short, and the average trade daily volume. Why? Because if that number is very small, that will give you faster access out of your shorts. If that number is very high, good luck, right? You're going to be standing in line to sell your stocks. You're going to be in a squeeze with a high probability. You understand what I'm saying? That's that. Now, I'm told, I haven't been able to verify this, but I'm told that the Marvin Capital, who was the hedge fund that was short GameStop, had a short interest ratio which was not just bigger than 1. I was told that the short interest was actually higher than the number of stocks issued. But I find it very hard to believe. I mean, the Lockheed Press didn't work, but anyway, that's what the literature says, right? I find it very, like, I've never seen that. I've worked with managers who are short lots of things, and you always look at that. Always look at that. If that number approaches, like, even 20%, like, big alarm, right? So I'm telling you that. I've been told of the situations where professional managers don't do that. So okay, I don't care to believe or not to believe, but I've never seen that. This is a number that is also always respected. And in this area, there is people who are very good at this, short selling gurus. Many of them, sooner or later, get indicted. Someone accused them of market manipulation because they say something bad about a stock. So, oh, that's because you were short. Market manipulation. The SEC comes in, they indict you. Oftentimes, as you have seen, that's enough to cause problems, right? Even if you're innocent. So this is an area which is very, very tricky. I don't recommend that you go there, except very surreptitiously. Okay. But so I've told you about buying stocks. I've told you about selling stocks. I'm going to now tell you about going long and short at the same time, which is where a lot of these things now get to be very, very interesting. But I want to take a 10-minute break before we do that. So we've seen how to go long stocks and go short stocks. The interesting part happens when you put that activity together, when you go long and short at the same time. So to explain that, I'm going to start with this example I have here. This is a portfolio. Some of these ticker symbols no longer exist. I did it a long time ago. It doesn't matter. It's still very significant. I have here an example of a long short portfolio, very typical of what hedge funds would do. You can see some of these ticker symbols here, and then some information about prices, again, very obsolete. And then you have the positions to the right on both the longs in black and the shorts in red. So what we see here is that most of our portfolio is long, right? And we see that there is a single name short, which is Google. And what you may notice is that as a short, it's much smaller than the typical long position. That's usually the case. Why? Because there's more risk coming from the shorts than the longs. So from a risk perspective, even a company like Google is, well, Google is not going to be taken over by a company, but still shorts are typically. And then we have look, it's a very large short position. That's on the S&P 500. That's the SPY. It's the ETF that replicates the S&P 500 index. Why would you do that? Aren't you afraid of the risks of the S&P 500? And the answer is no, not really. None of the risks that we saw would apply to the S&P 500. First of all, I don't expect a short squeeze on a market which is like trillions of dollars big. It's not going to happen. I don't expect the S&P 500 to be taken over by Microsoft, for example, and the price jumps by 4. times for just that. It's not going to happen. So none of the risks that we saw on the shorting of individual stocks will apply to the shorting of an index. So you're safe there. And that is, as you can see, the size of that is approximately equal to the sum of all of the long positions. So what you're doing when you're taking this big short is you want to make a return which is independent of market moves. And again, hedge funds don't have to do that, but this is a very typical situation. You want to make money because your longs, Walter Industries, Apple, will perform better than the average stock or better than the index. That's what you're betting here. When you're long Apple, it's not that you think Apple is going to go up in price. You just think it's going to go up better than the S&P 500, or maybe even better than that, better than the NASDAQ, because the other short that I have is a sector index. It's the QQQQ, which is the ETF for the NASDAQ index, right? So you're building a carefully chosen portfolio with some stocks that you think are good and some stocks that you think are worse. Not bad, but worse. You may think that Google will do better than Apple. That's why you're long Apple, short Google. Maybe both of them go up. Maybe they're both good, but you think Apple is better than Google. Maybe both of them go down, but you think Apple is better than Google, so you think it's going to go down less than Google. And in any case, maybe the comparison is not with, say, Bank of America and the Dell Corporation. Maybe the comparison is the S&P 500 and the Bank of America. You think Bank of America will do better than the S&P 500. Understand? So this is a relative trade, relative value trade. You think your longs will do better than your shorts. Understand? Okay, so that's easy. That's easy. But what's key and a bit more complicated is the following question. How much money do I need to support this trade? I know you don't have a mental calculator that says, oh, but let me just so you understand. Let's say that the value of all the shorts is 15 million, and let's say the value of the longs is also 15 million. If you sum all the numbers in black, you get 15 million. You sum all the numbers in short, you get 50 million. Let's just say. How much money do you need to do this trade? 15 million? 30 million? Zero? What? Zero? Zero? Okay. So I'm going to give you three answers, and I want you to raise your hand. Okay. The answer is neither of them. It's going to be something different. That's what. But I want to have an idea. So I'm going to give you three answers. One is zero, as you said. One is 15 million, and the other is 30 million. Okay. So who says zero? I don't vote. You say zero. Okay. Who says 15 million? Who says 30 million? Oh, many of you don't think. Okay. All right. So let me tell you what the answer is. The answer is very interesting. And it's, of course, neither of them. But I think you understand what I'm saying. And by the way, the answer, I pose it like that because it's easier to pose like that. But the real question is, if that's the portfolio you have, and you have 10 million, 100 million, how much of this can you do? It's called position sizing. With the money you have, how much can you buy? In the tradition, if I had a single stock long, we know the answer. If you're going to buy $1 million of the stock, you need $1 million to buy the stock. That's very simple. But if you have longs and shorts, the shorts are going to give you money. So I know what your argument is. My shorts will give me the money I need to buy my longs, so I need nothing. I can do this for free. That would be an answer. Some of you, I think someone raised your hand and said, well, actually, if something tells me that I will need some money to do this, right? How much? I don't know. So that's the answer I want to ask. But I want to ask it like this, which is easier, but you should know that the actual implication is once you have a certain amount of money in your fund, 100 million, 200 million, and you're going to build a portfolio like this, well, how many stocks can you buy? Because according to your argument, I can buy as many as I want on the long and on the short side. There will be no limit to what I can do. Well, there must be a limit. What's that limit? And that's what I'm going to address now. Yes?
I was just curious about when you say how much it costs, like the financing fees associated with the short.
Yeah. Okay. So yes. Okay. So let me move on. I just wanted to announce my next step, and in my next step, I want to adopt a very, very simple position. Very simple. There's only two stocks, A, B. Both are $100. A is the one I like. B is the one I don't like. But I'm gonna do a similar position. I'm gonna go long 10 A's. Sorry, 9 A's that cost me $900. I'm gonna go short 9 B's that will get me $900. That's the trade I'm going to do. How I get to that trade, that's not our concern right now. It could come because you're a fundamental trader, growth, I don't care. Quant equity, I don't care. We have decided we like A, we like B, and we're going to buy 9 A's, we're going to short 9 B's. But again, remember, in practice, you don't know how much you're going to buy. You know how much money you have. So I'm going in reverse because it's easier. I tell you what portfolio I want to build, and then we're going to calculate how much money we need. But in practice, you're going to do the other way around. The only difference between what we're doing and reality is a division. That's the only difference. Okay, understand that? Okay, so I'm going to adopt this point of view, which will make things easier for me to explain. So I'm going to assume I was right. A was better than B, and just to show you how I'm going to build my portfolio, let's say that in a year, after a year, A went up by 10% and B went up by 5%. So I was right. So I'm going to make some money because I'm long A and short B, but I want to go into the whole application of that. All right. So to do that, I'm going to build my balance sheet. I'm going to see how much money I have. And I'm going to assume I have $1,000 just to start my calculation. Once I answer all of the questions around the sizing, then again, you can divide by any number you want and you get the answer. Let's say I have $1,000. And I'm going to do my accounting statements if I have $1,000. Okay, I know that you think you can do this with zero. I'll do that too. Okay, but I'm going to start with $1,000. With $1,000, after a year, I have $1,000 in cash. 0% interest rates, by the way. Okay, I assume 0% interest rates. Then I can see that my long A's will give me $90. So I'll go from $900 to $990. That's my long A position. My short B will cost me some money. It will cost me $45. I'm going to be very realistic, and I'm going to assume a short selling fee of 1%. Now, I mentioned earlier today that when you short sell, you have to pay a rental fee. How much is that? Well, it depends. It actually depends on the stock. Some stocks, the typical cost is about, if it's in the US, it would be Fed funds, so risk-free rate of return, plus maybe 35 basis points. But 35 basis points are an awkward number, so for class today, I will assume 1%. Sometimes I have what's called hot issues, stocks that everybody wants to short, in which case brokers are not stupid, they charge more. I'll tell you about some of those later. Right now, I'm going to assume 1%. After a year, I make $36 in this scenario. Or in other words, I made 3.6%. I can clearly do this trade. Right? With $1,000 of buy A's, shorting B's will give me even more money, so I can certainly do this trade. I'm going to call this the conservative trade. It's conservative because some people like you think I can do it with less. Now, before I go to your case, which is the extreme case, I'm going to stop in an intermediate case. I'm going to call this the aggressive trade. I'm going to do this with only $500. Why is it aggressive? Because some of you may think, wait a minute, $500, I cannot buy 9 A's. I don't have that, right? So no, I know, but as you would probably tell them, I don't have enough money to buy 9As, but if I short 9Bs, I'm going to get $900, which I can buy 9As with, and I still have money left over. And when I go after a year and I pay my rental fee, I make $72. In other words, I have a rate of return of 7.2%. Okay? Okay. Now, before I go to your trade, which is the last one, I call it the impossible trade, but I'll explain why. It's actually not impossible, but I'll call it the impossible trade. Before I go there, I want to stop here for a minute because I want to use this as an opportunity to explain something else that I already explained, that we already went through last week, but now it's here in front of our eyes in different shape. But I want to make the connection. I ended my course last week talking about linear regression, remember? And I was doing comparison and I introduced some. Well, let me tell you, because I want to use that for this particular example before I continue. This example will help us understand lots of different things. This example will make connections with many things we have seen in this course. Okay, this is the first one. So before I go to the impossible trade, I need to say something. And I'm gonna ask you questions. So my discussion today is going to be very Socratical. I'm going to be very Socratic. I'm going to be asking a lot of questions. Who's happy with that return, 3.6%? Are you happy with that? Okay, don't answer. Another question, what's the return of the index? What's the return of the index? Don't tell me it's not in my data. With the data you have, what is your guess of the return of the index? Huh? 7.5. Why? Have two stocks, 10 and 5, 7.5. Right? You have to be practical. Okay? So 7.5. So the index did 7.5 and I did 3.6. You think that's good? Or bad? I'm going to have a very quick vote. I want to do it quickly, so I'm not going to go, so people on Zoom, you don't have to vote, okay? I'll do it with the people here. Who thinks this is a good return, 3.6? Who thinks it's a bad return? Okay, all right. Why is it bad return? Can someone explain to me why you think it's a bad return? I want you to think about this in the right way. Can someone tell you why this is a bad return? Those of you who raise your hand. Why is it bad?
You have like your $1,000 that, so if you just buy the index, you would get like your 7.5.
Okay, so you think, okay, so thank you for that answer. You're telling me that it's bad because the index is better. Great, okay. Can we compare the return of this with the return of the index? Last week we saw that every time we look at the return, we can only compare returns with each other if the risks are the same. So is the risk the same for the index as it is for this one? I let it hang in there. I want you to think about that. If you're comparing this portfolio with the index, from the return perspective, that would mean that the risk should be similar too. And I leave the question out there, are the risks that they take similar? Don't answer. Eric, what were you going to say?
I just want to comment on the risks.
Tell me.
Yeah, the risks are different. And
completely different.
Yeah.
Exactly.
And with the 3.6% with the short sale, it even has higher risk because of the short sale.
Okay, so sorry, which one has higher risk?
The short sale.
This has higher risk than the loan portfolio?
I think so.
Yes, you think so? Thank you for that answer very much. I'm going to tell you why I disagree with you. I'm playing here with two stocks. What can I tell you? Okay, that's my whole market. But let me tell you how I would think about this. Maybe I convince you, maybe I don't, but I'll tell you how I think about this. When I look at the risks, I only have two stocks. So I have a variance covariance matrix of 2 by 2. So I know the risks are given to me by two eigenvectors and two eigenvalues, right? What's the first eigenvector, or the eigenvector with the largest eigenvalue? Which one is it?
Is it 1, 1?
1, 1, right? What's the second? I cannot hear you.
Minus 1
1 minus 1. Actually, this portfolio is the second eigenvalue, right? Yes? So which one do you think is bigger? The first one with the largest. So I would think that the eigen, so this is actually very easy, right? You see? The market, 1, 1, we know from experience, your assignment number 1, although that was in fixed income, the market is the largest eigenvalue, is the one that has the largest variability. Therefore, I would think it has the highest risk. This one is the second. 1 minus 1 should have lower risk, right? Did I convince you? I'm not trying to convince you. I'm just telling you how I think. So this portfolio has a lot less risk than the market. In fact, if I go back to your assignment number 1 and I take the same ratios, maybe I would say, and actually I happen to know this, that the market, the first eigenvalue is about 75% compared to the second one, which is about 25%. In other words, I would think, this is my intuition, that the first eigenvector has 3 times the risk of the second eigenvector. So if I do a Sharpe ratio calculation between the profitability of the market with a 7.5% and a risk which is 3 times this one, right? The Sharpe ratio of the market would be 7.5 divided by 3, which is 2.5. Right? And this is 3.6. So this is slightly better than the market. I'll give you another way to think about that, which is if the market goes down, for example, by A going down 5% and B going down 10%, my portfolio performance will be exactly the same. That goes to show that my portfolio does not share the same risks as the market. That's why comparing the performance of the two is very difficult. I gave you an eigenvalue. I gave you a spectral way to think about that that shows that this is perhaps better. But I will need the variance covariance matrix. I would need to redo your assignment number 1 with these 2 stocks. Give me the historical time series and you would know what to do because you did it in your assignment number 1. Understand what I'm saying? Yes? Everybody understands? So you did this yourselves. So first corollary of this, you're stronger than you think already. Yes? Yes? Okay, when I go to the second one, how's the return of that? Many of you agree, I don't know if I asked, but I think you would agree that this is better than that, right? Okay, let's do the Sharpe ratio. Again, I'm just doing the Sharpe ratio because we know that it has some meaning, that's all. What's the Sharpe ratio of that? Is the same as this. The Sharpe ratio is the same. The return is twice, but the risk is twice. Right? In other words, whether you agree that this is better than the market or not, you should give you the same answer to that one. This is just from a risk-return perspective. Yes, you can argue that this is a very old framework done by Markovits many, many years ago, that the standard deviation doesn't cover it, but that's all we have. So from a intuitive perspective, I want you to understand that these 2 portfolios are just as good as they should be because the decision that we took when we built them was the same. Yes? All right, so the only thing as you can see, I took a detour from what I discussed today to make connection with something we saw last week. Last week was all with linear regressions and mathematical formulations and this and that. And I know that you know that. And I know that when you put things in abstract mathematical terms, you understand. I know that. You're trained that way. But here I want you to see that something you have to get out of that mathematical formalism and recognize the things which are in front of you using the same formalism that you're very, very good at. I don't know how many of you saw the eigenvalues here, but now you do. Yes? And that gets you to think. And by the way, if I go back, I forgot who was trading with me last week. I forgot. You were one. There was another person. That was you, right? Yeah, so you were my Hedge fund, you were my mutual fund, right? No?
How is the relationship done in
Who? No, I forgot. Okay.
What's the other house?
Alpha and beta. What?
I was the alpha.
You were the alpha, right? Yes. Who was the beta? You were the beta, right? Okay. So you're this. You're the alpha because you have nothing, right? You have no beta here. This is pure alpha. And pure alpha is always in the hyperplane, which is orthogonal to the first eigenvector. This is in the hyperplane orthogonal to the first eigenvector. You understand? Everybody understands? That's it. So that's where alpha lives. That's the trade you will never do this trade. This trade will get you fired. You will do it. Right? How would you do it? If you are a mutual fund manager and you like A more than B, what would you do? Just buy A. 100% of your money in A. That's what you would do. That's the only thing you're allowed to do. And then your beta to the market is going to be very high. No, not quite 1, but very high. And that's good. That's what you're supposed to do. So that's how you would do this trade from the perspective of what we saw last. Did I make the connection between this and last week? I'm talking about something different here. I'm talking about how to size this in a hedge fund, pure alpha situation. But from a portfolio theory, what we discussed last week, without the mumbo jumbo of the linear regressions and the betas and the alphas, this should be very clear now to you. Yes?
So in that case, would the largest and second largest, or the eigenvectors of the largest and second largest eigenvalues be orthogonal to each other?
Oh, they're always orthogonal. Always. Oh yeah, eigenvectors are orthogonal always. Always, by design. That's the beauty of them, right? They give you different market directions. And that's why you cannot compare this with the market, because they're orthogonal to each other. So we can't. Yes?
When you say this is pure alpha, you do need to assume that the two names are perfectly negatively correlated, right?
Well, yes, you're right. I mean, yes, exactly. So this would be the case. No, actually, that's not true. No. No. Okay. I'm assuming that they're actually highly correlated. That's why, but not perfect. I mean, yes. Okay. Okay. No. They're positively correlated. That's why the first eigenvalue is 1, 1, right? If they were, I don't know if we're understanding each other. If they were zero correlated, then both eigenvalues are just as big, right? If they're positively correlated, then the first eigenvector would be like 1, 1. If one has bigger risk than the other, then it will be maybe 1.2, 0.8. But roughly more or less of the same size. The first eigenvector, as we went through here, is the index. So yes, let's say equal. That's why that's the intuitive. I'm doing intuitive linear algebra, okay, which is, by the way, the one that matters here, because I don't have a time series. I cannot calculate anything. I can only think. I'm using intuitive thinking. Intuitive linear algebra is extremely useful. That's what I'm doing. I cannot tell you what the index is, whether it's 1, 1 exactly. I don't know, but I think it is. Yes? It's the intuition I'm aiming at. Do you understand the intuition? Okay. When you're doing intuitive linear algebra, the intuition is your supercomputer. Will diagonalize so quickly. Will drive at conclusions so quickly. You don't need to know if it's exactly this or that. Yeah?
Yeah, I was picturing, I was thinking that the old case where the typical pair tree, you want them co-move in opposite.
Yes, okay.
This
That's
is
good. Yes, no, so, yeah.
non-negative.
Yeah, so I'm making a connection between the very rigorous linear algebra and linear regressions and all of that with this intuitive, very fast intuition. Okay? Okay, so I'm ready to come back. This example will take me a long time because now I'm explaining lots of different things with a single example. Then I'm going to go to the impossible trade. Of course, this is infinity return because look at that, it's wonderful. I make $36 and I invested nothing. So this looks like too good to be true, right? Okay, so let me talk about that trade. And I call it impossible, but it's not really impossible. In the 90s, a very successful bond trader called John Merriweather left Salomon Brothers and created his own hedge fund called Long-Term Capital Management. Have you heard of that? Okay, I'll tell you about Long-Term Capital Management. Very famous hedge fund, very, very famous. He had two very famous directors in the fund, and we went through that last week, right? Myron Scholes and Robert Merton, who earned the Nobel Prize in economics in 1997. And they have been mentioned in this course many times. Scholes from Black-Scholes and Merton from the Merton model. Okay, these guys, right? So John Merriweather was very well known. When he went on his own, he created a hedge fund with a $5 billion, $1 billion. It was a big hedge fund for the time. I mean, now you have hedge which are bigger than $1 billion, but back then this was a lot of money in the 90s. So I'm going to give you a caricature of what he did. What I'm telling you is not correct. It's a caricature of what he did. But I want to use that as a way to, he was like you. Okay? He was not doing stocks though, he was doing bonds or fixed income instruments. It's not important right now. But he would go to Goldman Sachs and said, I want to do that trade. And Goldman Sachs would look at him and say, are you serious? He said, yes, I want to do that trade, but you have no money. He had a little bit of money, you know. He said, no, I want that. I want maximum leverage. His trade was not with A and B, which were stocks. His trade was, I'm making this up, a 39-year bond with certain coupon payments and a 29-year bond with slightly smaller coupon payments. So he would go long that, short that. I said, look, I mean, what's the risk here, right? Every few months, I collect a few cents of a penny, right? And then I just make money. There's no risk here because the curve does that. I make money. I make money all the time, just a little bit. That's why I need maximum leverage. And then Goldman Sachs would say, this is very risky. He said, then John would say, Mr. Goldman, I've been doing this with you for a long time. When have I failed you? I said, never. I said, why don't you give that to me? And by the way, look at that $9 there. That's for free. And then Goldman would say, yes, you're right. I'll do it for the $9. Understand what I'm saying? Great. And then he would go to Morgan Stanley. Same conversation. And then he would go to Merrill Lynch. Same conversation. B of A, same, you understand? CTP. Yes? He built a $5 billion portfolio that actually had exposure to over $1 trillion worth of bond notional. And then in the summer of 1998, two things happened. Russia defaulted on their debt, and the same week, Bill Clinton got impeached in Congress for his affair with Monica Lewinsky. No, because he lied about his affair with Monica Lewinsky. Understand? You remember that? You know what I'm talking about? Monica Lewinsky sounds familiar? Okay. Markets straight up. And what happened is, well, the bonds that were more expensive, that they were short, were very liquid. And the bonds that were very cheaper, were very illiquid. So they went down in price a lot, and that difference started to become very much against them. So much that Goldman said, wow, your balance is very negative now, man. You have to put some money here. So it wasn't a short squeeze, it was a margin call, which we're going to see today, okay? And then Morgan Stanley, Merrill Lynch, everybody was doing the same thing. And eventually, this is the Hollywood explanation of what happened. All gathered in the same room with the Federal Reserve Bank in the same room and said, I have a problem. I don't have the money. The Fed took over, said, okay, let's unwind this portfolio without blood hitting the river, and this and that. And it's a story which you can read. It's there. I'm giving you the, how can I say, the simplify. I apologize to Meriwether for this hypersimplification of the situation, but I put it into this context. So this was possible in 1998. But yes. But then I remind you, and this came up when we talked about risk management, remember? Then Basel II came up in the year 2000, which was a consequence of that fact. And Basel II has no business. This is a conglomerate of central banks. They have no business regulating hedge funds, which is private capital. People with their money, they can throw it out the window, right? But what they did is they regulated this by regulating credit. And what they did, and we saw this already, and now it's coming up. What Basel II, what the regulators did is banks, when they take risk like that, someone has to pay for it. So the banks will not do that now because the cost of capital to the risk is much higher than the $9. And you know about that because we saw that example where we did the credit trade. Remember that? We did a credit trade. Who was my trader that day? I forgot. We did a credit trade. We had a cost of capital. There were two trades. One was a hedge fund, one was a bank. Remember that? We saw that a few weeks ago. Go back and watch the video. We saw that. And we saw how the cost of capital, which is given by regulatory constraints, will increase the cost of doing your trade. So what the regulators did is increase the cost of capital so that that trade will never happen again. And that's how they did it. Do you understand that? I don't think you understand. I have a feeling that you don't.
I'm curious, so if after those regulations came out, should make this in principle a lot harder, you mentioned that the regulation said someone should have to pay for it. So when I hear this, I think a lot of like the Archegos situation with Bill Huang. How did that not get prevented, or was the regulation just to say that, you know, Credit Suisse must fall, like someone like in the private sector just has to?
So we're talking about what period? Because regulation has been changing. We're talking about 1998?
Yes.
Okay, so in 1998, regulation was done differently. It was a percentage of the risk capital, and we went through that. It was 8% of the risk capital, right? So what's the capital in a situation like that? I don't know, but it was very low, right? Because this is a nonlinear instrument. So that's why Basel II was done to capture the risk coming from transactions like that. Okay? All right, so I call it an impossible trade because now the cost of capital will be much, much higher than the $9, so you cannot do it. In fact, the way this works is as follows. There's a margin, which is a consequence of the regulation. Basel II has a regulation which is, we went through the risk matrix, you remember that? So there's a credit matrix, there's some calculations with covariance matrices and this and that, blah, blah, blah. Right. So the short of that is that this finds its way here through banking regulation into hedge funds, which are private pools of capital, but the minute they go to the bank, it's no longer a private pool of money when it comes from the bank. The bank now has risk, and that's how the regulators get to regulate hedge fund activity. You have it here. And they would say, I can lend you money to buy your stocks because it's good business for them, but I will lend you up to 50%. That means if the stock drops 50% in value, they can start to take losses. They revise this every day, so the risk is low, right? But for shorts, they demand 80% of collateral. That means that they only allow for the stock to go up 20%. Then you are in a negative, and they have to, in a negative position, you have to put more. That's how the collateral is calculated. And this is a number which is there. It changes, good clients can get better deals. But I want you to understand that this number is related to the credit matrix number that we saw several weeks ago. They're all related. The banks are the ones that have to make the translation from their cost of capital, their risk, their obligations with the regulator, and what they charge to the hedge funds, and the risk they impose on the hedge funds. You understand that? I'm making a connection between two very different sections of this course. And this is it. This example encapsulates many things that we have seen in this course, many things, from last week to several weeks ago. All right? So let me tell you how this would look like for a particular case. If I calculate the collateral I need for my 9 A's is 450, my collateral for the short B's is that I will have an income of $900 from the short positions, which means that my total required capital is $270. So I can do this trade with $270. So I got your name? Sam. So Sam, you wanted to do 0? Sorry, 270. Okay? 270. All right, and with 270, I get a pretty good return. I still make my $36. I have a return of 16.67%. That's pretty good. Are you all with me? Great. Who wants to be like Sam? Raise your hand real high. You, Gabriel, Max, Sam, anybody else? Henry? What?
It's free money, right? If you have 0.
It's free money, right? Great. Okay, so you guys are the free money guys. Great. Who wants to stick with a conservative trade with $1,000? Like you don't want to take any risks. Anybody? You, your name? Arvind. Anybody else? Arvind? Victor, right. Arvind and Victor. Okay, these guys are just observers. You don't like to trade. You work hard enough. You don't want to make money. All right, so I got all my traders here, right. Okay, so let me go to another example that happened in 2007. This is wonderful now. 2007. I'm telling you lots of stories today, okay? 2007. Subprime, you know what that was? The subprime crisis, have you heard of that? What was that? That was a whole bunch of mortgages given to people with low credit quality, subprime, right? And around March, it was discovered that, oh my God, it looks like these CDOs that were used to make risk disappear was not such a good idea. March. And market was very, very jittery at that time. People were very nervous. So a lot of people were calling the big banks, say I'm Goldman Sachs, and they were telling me I want my money back. I said, when? I said, oh, well, as soon as you can. I said, well, how about September? Typically, you do these things at the end of the quarter. So September is fine. Okay, great. So I know I have a few months to unwind a lot of my positions, and I'm long lots of A's, millions of A's, and I'm short B's, billions of B's, millions of B's. You understand what I'm saying? So I wait for a very quiet day in the summer of 2007. I said, today no one will notice. I start selling A's and I start buying B's because I need to unwind my positions, right? So one day, October 13, 2007, I start dumping A's and buying B's. You understand why I'm doing that? Everybody understands? That makes the value of A go down and the value of B go up. So what happens to you? This is a variation margin. As you make money, your collateral goes up, but as you lose money, your collateral goes down. Your collateral requirements are the same. That means I'm also Goldman Sachs. I'm also your broker. I call you. I said, I forgot your name already. Sam, you gotta give me some money. What do you do?
Pardon?
What do you do?
I didn't hear the question.
You have to give me some money. I need $10 from you.
Take it out of the 270.
What?
I've got cash.
You have no cash. No. That's the collateral you need. You cannot spend your collateral, Ben. You need the 270 goes to 280 now because you lost $10. What do? I'm still waiting. Quickly, I have like 2 seconds. So, yeah, you have to sell A's and buy B's. You have no choice. Great. So that makes A go down and B goes up. My God. So hold on quickly because I have to call Henry. You were the same trade, right? Yeah, you all took APM 466. You were all long A's and short B's, by the way. Okay. Same with you, right? Because you're also 270. So quickly, I need now $15 from you. What do?
So I have to like.
You have to sell. You have to sell. Who else was here? Gabriel, you were here too? $20. You? Max, right? $25, right? And B continues to go down, and A and B continues to go up. And B was like the worst stock you've ever seen, and A was fantastic, full of cash. You loved it, right? But you don't have a choice. Now, who else was on this trade on the $1,000 side? Victor, $1,000. What do? I don't call you. You have like plenty of collateral, right? I don't call you. What do?
If I think A is gonna go up, I'll buy.
Well, you do is you call the broker. That's what you always do. Because the brokers are a very good source of information. You call me. Say, Goldman, what's going on? I said, sorry, I'm in the middle of a lot of margin calls. And then you know what's going on. I said, oh my God, Henry, I'm sure he's been caught. This guy was a risk taker, right? And Sam, for sure, he was there too. So you know what's going on. I said, okay, that explains why A's are going down and B's are going up, right? And then you wait until it's over. And then you go in and maybe, if that's okay with you, you can increase your risk tolerance a little bit and buy some really, really cheap A's and short sell some very, very expensive B's, right? That's how these guys die, and then you make some money. Yes?
Only after they die. Only after they die. I can do it.
No, you don't. Actually, they didn't die. They just lost so much money that they had to retire, and then. But you decide. I'm not telling you when. That's a different question, right? But I want you to understand the risk that you have now if you go to the limit, right? Looks like a great trade, but boy, I mean. And so how do you calculate the risk of that? So I have here some calculation, all right? It's how a margin call is generated. Just going through that, I told you in vivid example how that happened, and I have the example here. We went through that. And now this is an issue because we die. We don't have the money to make up for the losses, right? So what do? Well, we have to calculate a different risk, which is the risk of a margin call. We saw how we can die from a short squeeze. Now we have to understand how we can die from a margin call. A margin call is never a good idea. It's always bad. And let me ask you, how can we calculate the probability of a margin call? Because that's something else we've also seen in this course. If I look at my portfolio has, say, Brownian motion movement. What's the margin call? The margin call is a hitting time. Is when my portfolio hits the minimum margin required. And we've seen that. We saw, you forgot, but you probably remember that we saw the probability of a hitting time for Brownian motion. And actually, this is slightly different. This was the cumulative probability of the highest value of my Brownian motion, which is the probability I got hit even sometime in the past. And there was a formula for that, which was this one. I know you forgot the formula, but I hope you remember that we saw it, because that's how this course touches on yet something else that we saw a long time ago. And now I can calculate a different source of risk, which is the risk of a margin call. And this, by the way, shows that if you invest with $270 as your capital, the probability you get a margin call is 100%. So you would not do it. 271, maybe. The probability is like only 99%, right? But that's how you calculate. You understand that? Yes.
Is there any law forbidding it, or is it just really stupid?
So, no, it's just stupid. No, the bank is happy and they collect their $9. And see, the bank has their risk covered. You don't, but they do. That's why the $270 requirement is there. They're still making money. But you will die, and they know it. And they say, well, when they go to work at 6:30 in the morning, said, has Sam died yet? No, it's still there. Okay, let's wait, maybe today. Right? You understand this? This is real. This is the real world in a very, very simple example. You feel powerful? Lots of things you've learned in this course. I mean, I know that they were not ready there. You had to go into the self, your mental self. Oh, yeah, I saw that, I remember. But everything was there for a reason. And then these things come up. It's not that I put it together myself, but this course is useful. Lots of things we have seen, they actually get to be used, right? Okay, we're going to take another 10-minute break. When we come back, I'll talk about convertible arbitrage. So I'm going to talk about convertible arbitrage now, and I also have stories to tell you here, and I think I'm going a little bit slow today, so I'm going to have to pick up the pace. I hope it's okay. And we've talked about convertible bonds already. I remind you that a convertible bond is one that is basically your last resort when either borrowing money or issuing stock does not work for you and you need capital. Okay, there's many examples of that, which we will see. There's one in particular that I want to tell you. Convertible bonds were the method that ultimately saved the banking industry in 2008. I'll tell you about that later. But what I want to do now is I want to talk about how a convertible arbitrage comes into the equation. What is it, and how can we use it to take advantage of certain situations to make money? And what I'm going to do here is, so, there's some context as to when convertible bonds work. Again, this is done for companies which have less than good credit and they need to raise money. But I want to focus everything on this example. This example that we have here is the one that I want to use. Okay, so it's a company behind it, that this company has some difficulties. They're having difficulties raising money, and they're issuing a convertible bond. Works as follows. I have the numbers here. The bond is selling for $80, so that's a $20 discount already. That's pretty good. I'm assuming that there's a coupon payment of $4 for the bond. I'm also assuming that the interest rate is $4. The risk-free interest rate is $4, so the coupons are issued at parity. But the bond is sold at a discount. That's where you can see that the company has a certain credit spread. That's why it's selling the bond cheaper. And the bond has a convertibility feature. You can convert the bond into 10 common stocks anytime. Anytime. And the stock trades at $7. We're going to buy the bond. I have $80 in my fund. I'm going to buy the bond at $80. Right now, we know that it's risky, right? We're not going to get into the margin call calculation. That's not, I assume I have some cash out there. It's not a margin calculation. It is just that I want to see how my $80 when I buy the bond would work. But of course, I'm going to hedge my position. I'm going to assume that I have some concerns with the company, and I'm gonna hedge. And I'm gonna hedge by shorting all the 10 stocks that I can convert my bond into. So my portfolio is 1 long convertible bond and 10 short stocks on the same company. Okay? That's my portfolio. I'm going to show you here how that works. I'm going to assume a very simple scenario, call it calm scenario, in which nothing changes for a year. I buy my bond for $80, and after a year, the bond is still at $80. I short my stocks 10. So I have a liability of $70, cash of $70, that in a year is the same, except the cash I will invest in a treasury bill that gives me 4%, zero risk. It makes me 4%, which is a total of $2.80, or my treasury bills will have a value of $72.80. And I have to pay a fee. We already agree, we pay a lending fee of 1% plus 4% interest rates, that's $3.50. That's for my short position. That's the accounting for my trade. Yes? Very simple trade. One long convertible bond, one short stock, the cash invested in a risk-free interest rate account. And the fee. The lending fee, which I have to pay the broker. The ongoing interest rate, 4%, plus the bank commission. It's not 9, it's 1%, still 1%, as we always assume here. So I can see my $80 become $83.30. Okay, let me ask you the same question as before. How do you like that return? It's about 4%. How do you like it? We've learned how to calculate returns. We have to compare that with the risk that we're taking, right? 4% is pretty bad because I can obtain that return with zero risk by just buying the treasury bills at 4%, right? So this, it looks like this is not a very good return. It's not a very good return. You can do the same return with zero risk by just buying the bills. Okay, so why am I telling you this? Well, let me show you another case. Let's say that the company goes bankrupt. The company goes bankrupt, the bond goes down in value to the recovery rate. I'm going to assume 50% recovery rate. Doesn't matter, it's just a number, okay? Yes? The stocks, I go from owing $70 to owing nothing. My hedge worked beautifully. My coupon payment is zero, it's part of the recovery rate, I get nothing. My cash gives me 4%, $72.80. And I still pay my short lending fee, $3.50. Net result, I make a lot of money. In fact, compared to interest rates of 4%, I make 46% in addition to the risk-free rate of return. What is that telling you? This is a very good trade, right? Now it's a good trade, but it's a different scenario. So maybe what I would think is that, whoever did this trade, that's what they were doing. They were betting on the company going bankrupt, don't you think? Okay, let me give you another trade. Why don't you just short the company? Forget about the bond. You will make even more money, right? What's the problem? Is that a fair comparison? We know that to compare returns, we have to compare risks too. In the previous case, there was no comparison. I could get 4% with zero risk, so that was not a good scenario for us. This is a good scenario for us, but is it better or worse than if I just short the stock? If I short the stock, I get 100% return. It's more than 46, right? So is this better or worse? What's the risk profile of going short the stock? The risk profile of going short the stock is not the same. Imagine I have explosive success of the company. What happens if I'm short? Let's say the company goes from 7 to 14. I lose 200%. That's pretty bad. What happens if I do this trade? If I do this trade and the company goes up from 7 to 14, I convert my bond into 10 stocks, right? I have the conversion there. I got my T-bills. I pay my fee. And I lose almost nothing. I lose a little bit, but almost nothing. So clearly, from a scenario perspective, this trade is far better than doing a short on the stock. In fact, given this analysis of the three scenarios I gave you so far, I would think that the portfolio manager is really interested in shorting the stock. The convertible bond was just a hedge to the short. Don't you think? Yes? Okay, so let me walk you through some other scenarios. Let's say that I just do a little bit worse. The company does just a little bit worse. And I have two possibilities of what that means. The bond goes from 80 to 73 or 70, and the stock goes from 7 to 6. Usually the stock and the bonds move together. You know that's not always true. In fact, you could have that rates go down, so bonds go up and stocks go down. It could happen. But in this example, I assume that they move at the same time. I'm not taking into account movements in, say, the interest rate market. So if the company does a little bit worse, and I do the same calculations, this is accounting very similar to what we did earlier, I get that I make a little bit of money. In fact, we now begin to suspect that every time the company does badly, we do well. Bankruptcy being the best, being the home run, right? We learned that. And every time the company does a little bit better, we do a little bit worse. I have the exercise, I have the different scenarios here. I'm doing scenario-based analysis. We've seen that. Oh, sorry, there was no sound on Zoom. Sorry, guys. Sorry. So, there was no sound on Zoom. I had not unmuted myself. I muted myself during the break. Okay. You missed nothing. It was all in the slides. Okay, sorry. Next time you speak up, okay? Because I will hear you, but I don't have time to read the chat while I'm lecturing, so. Or call someone here and talk to them. So, all right. So every time the company does a little bit better, we do a little bit worse. This really was a trade built to bet on the demise of the company. So you have all the totals there, and this that well, I'm always doing the percentage returns compared to the risk-free rate of return. That's the way you would do that. Yes? Okay, so you can see that this particular portfolio was set up preparing for a bad scenario. Still, this is convertible arbitrage. And what I want to show you is how you would do this. I just walked you through that. It looks like a very lopsided situation where I make a lot of money in one scenario and in the rest I am like, okay, so, right? The good thing is that, or the summary is that I'm taking a short position on the stock really without risk or with little risk because the bond gives me the hedge. The way you would do this in practice is a little bit different. You would actually construct the convertible trade differently, not just like that. I just gave you this because I wanted for you to understand the scenario-based analysis. But let me use the scenario-based analysis to build the trade. So imagine I am a convertible arbitrage trader, and there's this company that is issuing convertible bonds, and I've hired one of you. You work for me and said, there's this company, give me the scenarios that you see plausible for the company to do evolution. And then you go there and you work. You go to work at what time? 6:30? Yes. What time do you go home? Now we talk about when you go home. Because this company is not trading. I mean, it is trading, but that's not, you have to come up with these scenarios, right? So I give you some information in the Bank of Nova Scotia Tower. There's a hotel in some room, in some floor. Sometimes people don't have time to go home. When you're in a situation like this and you have to get these numbers quickly because I need to do the trade, like, come on, what are you doing, right? So, okay, so I don't know when you go home or if you go home, but you have to get me these numbers. So these are the numbers that you give me. You've done the analysis and you've concluded that there's 3 possible scenarios. There's a 33% chance the stock is taken over, bought by Microsoft or someone, goes from 7 to 14. And of course, in that case, the bond goes to 100. But you convert, and then the bond will be 140. It's a convertible bond. There's a 33% chance that nothing happens. It's the same as before. The company will continue to struggle, but it'll still be there. It'll pay the coupon, but the bond will be the same. And there's a 33% chance of bankruptcy with a recovery rate, in this case, of 30%. Pretty bad. Okay? Great. This is the analyst's point of view. What trade do you do? You could do the same we did earlier, in which case here you will make not a killing now because you only have $30. You'll make good money. But how about there? You're probably not going to do very well. Or is that the best you can do? Why should you hedge all of the stocks on the downside? In this case, there's only a 33% chance it goes bankrupt. Hedging all 10 stocks is too much, right, for those scenarios. So maybe you should do something different, right? What do you do? Well, you would do what all mathematicians do. When you have an unknown, you call it X. So I'm going to call X, I have my scenarios here, I'm going to call X the percentage of the stocks that I will short to build my hedge. That's my unknown. It's a number between 0 and 1. Maybe it's 1, in which case I do a full short. Maybe it's 0, in which case I don't even hedge. That's how you build a trade. Understand? You follow me? But how do you calculate X? So I'll give you a method. What I'm going to do here, I'm going to do accounting, X-based accounting. Accountants cannot do this, but you can. For every scenario, as a function of X, you calculate how much money you make. And I did it there. It's exactly the same thing we have done with the scenarios of the past, but in this case, it's all a function of X. Right? You can do this. Great. So once I have that, why don't I calculate the Sharpe ratio as a function of X? That's the Sharpe ratio as a function of X. I have the return, I have the standard deviation. And I pick X to optimize my Sharpe ratio, which happens when X is equal to what? 8. So you buy the bond and you short 8 stocks, and they will give you whatever, but that's the best deal you can do. Right? That's how you would build a convertible arbitrage trade. And then you can go through the scenarios as before and do, but that's the best trade you can do. Okay. So let me tell you now a little bit about convertible bonds. Maybe tell you the story, and I don't know, have some other examples, but I want you to understand this, and I want you to understand how much more powerful you have become by looking at this example. And for that, I have to tell you what happened in 2008. I have here a trade. This is a trade that we did in my company in 2008. There was a trade on a Citibank convertible arbitrage. This is a real deal, okay? It's not like I explained to you in very simple terms. It's a real deal. Don't look at that. Let me tell you what happened. I'll give you the story. This is the backdrop. Let's just use that as decoration for my story. 2008. The world was coming to a financial end. It was very bad. Lehman Brothers went bankrupt. A bankruptcy that was permitted by the regulator because there was some sort of a war between the regulator and Lehman Brothers. They had been fighting with each other for a few months, and everybody thought that everybody was covered against the demise of Lehman Brothers. Okay. The fact of the matter is, as I think I discussed here, Lehman Brothers went bankrupt on midnight of September 14, Sunday to Monday. Then on Monday, the market were fine. Everybody was expecting the bankruptcy, and nothing seemed to be the case until mid-afternoon. Rumors spread that AIG, American Insurance Group, had issued credit default swaps on Lehman Brothers that were due because they went bankrupt. If they had not filed for bankruptcy, they were bought by someone, then it wouldn't have happened, but they did. And that amounted to big losses, and AIG was going to go bankrupt on Monday. So I believe it was Hank Paulson, the chairman of the Fed, rushed to Congress to ask for an $80 billion bailout plan to save AIG from going bankrupt, because the rumor was that if AIG goes bankrupt, Morgan Stanley or Goldman or both had issued credit default swaps on AIG, and then they would go bankrupt next. And then that's the end of, who knows, no one knew how far that brush fire would spread. So it was stopped there at that point in time. But the rumors that all banks had lots of very dangerous securities in their portfolio could not be stopped. And investors were becoming to be very, very, very nervous, in particular about the banks, which were at the center of the crisis because of all the lending that they had done through the inflated credit bubble. Understand that? All right. So this particular bank that people called Shitty Bank in 2009, one day it actually went below 99 cents. This is remarkable. Okay, check the stock price now, it's 99 cents. If it had closed at 99 cents, they would be forced out of the New York Stock Exchange, which is the, right? It closed at like $1.01 or something. All right. So, and this was in March of 2009. It was very, very bad. There was a lot of toxicity. And the government, the Fed, decided to bail them out. When people talk about bailout, they don't understand what that meant. What that meant is that the Federal Reserve Bank agreed to buy an issue of convertible preferred shares, convertible bonds issued by the bank with certain conditions. I have the conditions here. It's not important what the conditions were. Okay. There was a convertible bond, very similar to the one that I expressed here. And the Fed was going to buy those bonds. So investors, us in particular, we bought the bonds too, the convertible bonds. But you don't just buy the bonds as you saw. You do the calculation, as we did here, and say, well, I need to do some hedge, right? Hedging a bank at $1, if actually we hedged at $4, it's very painful because the stock went to 12. It closed at 12. Do you understand? We did a short at $4, and the stock, I believe, I don't know, I'm quoting from memory. I don't know if that's what that says, but when the convertibility happened, then the stock was at 12. So the short side of the deal was like a massacre. 4 to 12. We still made a lot of money. The convertible arbitrage trade was engineered, as I explained to you, more or less, and we made a lot of money. By the way, who made more money than we did? The bank was saved. Don't say the bank. The bank was happy, was there, but the bank didn't make money. The bank was not in the trade. The Fed. The Fed is the one who made the most amount of money. So what the Fed did with the bailout package was actually a lot of trades like this, some of which were very, very profitable. In fact, I suspect the Fed made a lot of money on the bailout package, something that people don't seem to understand. Of course, they don't understand because they don't know what you know, right? So this is how that's how the Fed bailed out the banks. They just went long the convertible, they made a lot of money. We went short at $4, we lost 300% or something like that, something ridiculous. On the hedge, we still made money, right? But the interesting part that I want you to realize is, you understand what I'm saying? Do you understand? You understand what I'm saying? Okay, great. So when the banks need money, we already saw that they issue convertible bonds because they trade issuing bonds. There was this bank in 2007 issuing a bond at 25% yield. Interest rates were like 2 or 3. 25%, no one wanted their bonds. Then they issued stocks. The stock price did like that, nosedive. No one wanted the stocks either. What do? Well, you know that, convertible bonds. But convertible bonds, on the one hand, they are a very useful fundraising security, and you know that, which gives investors some safety from the bond and total upside from the stock. That's what the Fed did. But it gives you another thing that now you also understand, which is you can come up with a trade that will have a very low risk profile and is optimized to whichever scenarios you have in mind. And they can be profitable. But you need to be able to short, otherwise you cannot participate in the convertible bond, right? The Fed can, but investors don't do it. It's too much risk. You understand what I'm saying? Guess what? September 17, 2008, both regulators in the United States and in the UK, they issued an order prohibiting short sales on financial stocks. At the moment when the world trying to raise money through convertible bonds, you know more than those regulators now. Because you know that if you do that, convertible bond traders don't want to touch those stocks. In fact, that was part of the reason why stocks keep on going down, because these banks could not raise the capital they needed to fulfill the regulatory obligations. You understand? I'm talking about big world affairs now, and you're in control. You have all the tools you need to be in control of that, to understand what happened between September 14, 2008 and March 11, 2009, and in part what led to this, right? As a regulator should know that, but apparently they didn't. That was a very self-inflicted harm on financial markets when they prohibited shorting, because the main thing is that no one wanted to touch those convertible bonds, right? Okay. Again, this goes to show how strong you should feel now. Because you've learned all these things, and it's all rooted on the math we've learned in this course. Okay? Yeah, so I'm now in the last few minutes of I have the convertibles to history, everything I told you is here. And financial markets work like this. We've seen stocks, long and short, we've seen convertible bonds. I have more things to continue. I have here, for example, merger arbitrage. This is a very famous merger announcement between Alcatel and Lucent. It was part of the .com effervescence of the year 2001, right? So this was a very interesting trade, because they announced the merger, and you can do an arbitrage. I'm not going to get into the details of that, but you can see that one of the companies was very highly rated, A-, and the other one was poorly rated, BBB-. So if an announcement like that is made and you want to make money, what do? You go long the bad bond and you go short the good bond, right? And then just wait for convergence, right? You know how to do that too. In fact, you can even size the position of that, because that's what we saw in the first half of today. Yes? What happened? Eventually that announcement was called off. That means that was not going to happen. And there's something else that we didn't discuss here, which you have to be quick. When that happens, you have to be quick, because if you enter into the trade, and you're the first one to enter into the trade, when the announcement is called off, then the trade goes back to where it was, and at least you didn't lose a lot of money. But if you're not the first one to get into the trade, you get into the trade when the movement of the long bond has already started to rise, and the good bond has started to fall, and then it converges back to the original value. When the announcement is called off, you're gonna lose a lot of money. Which is the reason why a lot of these decisions have to be made very quickly, and that's why it's something you have minutes to make decisions. Or if you have days, then probably you're not going to sleep a lot during those days, right? Because all of this analysis has to be done. So this gives you a very realistic perspective of how these things happen. I have many more examples here. You can go through them. This is not interesting because these things don't exist anymore. Maybe I end with the very famous trade, which is oftentimes not explained correctly, and that was the George Soros and the British pound. By the way, Scott Bessent was part of this trade, the Treasury Secretary in the United States right now. Okay, but I'll tell you how this trade happened because it's oftentimes misunderstood. You may know something about this. This was in the period that led to the creation of the euro, and there was political interest in Europe to make Britain to be part of that, to make the British pound to be part of the euro. It was not called the euro, by the way. Back then it was called the ECU. They changed the name because ECU in German means a cow, and they didn't want that name, so they changed it to euro. Okay. So they gave the British pound an unfair, well, not unfair. Sorry, there's no justice here. They gave the British pound a bigger role into that currency basket than the British economy was entitled to, because they wanted to make the British pound, or they wanted to make the euro attractive to the British government. So they were propping up, that propped up the value of the British pound. But in some analysts, fundamental traders, Soros and Bessent being one of them, it doesn't make sense. So they shorted the pound. It's oftentimes assumed that when you short the pound, you're actually taking, how can I say, you're weaponizing your trade. It's the way it's not true. You're taking a short position. We've seen how taking short positions can actually backfire, and you can lose a huge amount of money. They were right in that the value was artificial. And finally, in September 1992, the central banks decided to stop that theater, propping up the value of the British pound, which was, people would do the calculations back of the envelope. It was clearly wrong. The value was wrong. And then the British pound dropped by 20%, and they made a lot of money. George Soros made a lot of money on that trade. Okay, that's another example of what a hedge fund would do. It's the equivalent of a fundamental trade that we saw earlier, but on currencies this time. Because you do the analysis of the currency value, I say, well, the British pound is overvalued. Currency traders do that every day. And that's how currencies go up and down. They do it on the Canadian dollar versus the US dollar, on the yen versus the US dollar. That happens all the time, right? And sometimes you're right, sometimes you're wrong. So that's another example, okay? And, well, I could go on, but I think I'm going to leave it here. This is a good way to end it. I'm done with trading strategy. There's a few more, and you can read them if you're interested. But this is how everything we've learned in this course comes to coalesce and help us understand how these trades happen, why they happen, the risks that they have, the profitability they give rise to, and we've learned even how to compare profitability of different trades because their risk profile is different. Okay? Okay, this is the end. Next week we meet here, and I will be lecturing on what I believe will be the most useful part of this course for you. No math. There's one equation though, okay? You will see which one. No math, but that's where I will teach you how you have to develop your communication skills, not with computers, but with humans, okay? Next week.